Valens Research, Uniform Financial Analytics.
Dell is really interesting because Dell has really transformed itself over the last couple of years, right? It went from basically being a consumer computer hardware business to, right, it acquired EMC. It basically moved heavily into servers and IT technologies, et cetera, and value add work, and really transformed the business. And what's really interesting is when we look at this, a couple of things jump out. On an as reported basis, it looks like Dell basically has never been really that profitable, really not since all the way back to 2006. Well, the company has stayed around, and right, it's a $70 billion business. Even after it acquired EMC, like this company barely has a 3% ROA. In reality, we can see this company actually has been phenomenally profitable. I mean, look at this, a company that in its lowest ROA year, it was 20%. And last year, right, this is 2021, just because the fact that Dell's fiscal years are a little bit off. So its fiscal year ended in January. So we already have that integrated. Last year, it actually had 145% return on assets, right? That's staggeringly high, staggeringly high. But way more important than this, and understanding that this company isn't actually barely profitable, it is a high return business, is you would look at this company on an as reported basis and you would totally be misunderstanding its investment cycles. I mean, look at this. In literally 4 of the last 5 years, as reported growth rates for this company have been directionally wrong. In 2007, you thought assets grew by 160%. They actually shrunk by 28%. In 2009, you thought assets shrunk by 10%. They actually grew by 24%. In 2020, you thought this company was growing at 6% a year. It was actually shrinking at 40%. In 2021, you thought it was growing at 4%. It was actually shrinking at 5% a year, right? This is literally changing how we think about where Dell is in its investment cycles, in its profitability cycles. There are so many directionally wrong and modelingly wrong things about the as reported metrics that we don't even understand because we're totally missing them when we're looking at bad as reported metric data. It's only when we see the uniform accounting data that we can start to understand just how profitable Dell is and how it's been really managing its assets to improve that profitability over time while still being able to grow revenue. Right? That makes it more interesting when we look at this and we go, oh, market expectations are for returns to fall back, right, with the company trading at a 9 times multiple, but we can see returns ramping as opposed to shrinking. Maybe the market's wrong, right? It's a different conversation to have. We're not saying that Dell is wrong at all, but it's a different conversation that we're having because we're looking at the real uniform accounting data.
Valens Research, the world's leading source for uniform financial analytics.